Rate cut optimism from Friday's jobs report continuing to push markets higher in today's trade. Traders now pricing in a rate cut in September. Joining us now, we want to bring in John Stoltzfus. He is Oppenheimer's Asset Management Chief Investment Strategist. John, it's great to see you again. Let's start with the new note that you just put out this morning and was titled "The Song Remains the Same." So what does that setup then look like for equities, and how much upside do you really think we have from here?
Well, thanks for having me on the show, Sean. I would have to say, at least we think upside from here to the end of the year. Our target of 5,500 for the S&P 500 remains the same. Our expectations here are that, near term, we're bound to have volatility. The longer it takes the Fed to actually give the market an idea that it wants to believe as to when it's going to cut rates, that's all another story. With our thought is the risk in terms of volatility increases the longer the Fed remains on hold and the economy continues to slow. The question will be, when does the economy go into a recession? We think the Fed thus far, after 2 years of raising rates and pausing, 11 hikes, 7 pauses now, with no recession, has probably got a good chance to avoid a recession here. But it'll be kind of, it's going to take time. We don't think the Fed cuts until the second half of the year.
Do you have a date on that, John? December?
December is our favorite one. It almost seems inevitable. We think that'll be the thank you and good night, in terms of closing out 2024 for the Fed. And would be elegant in the sense that it will avoid any comments from different corners of the market about the cut being politicized by a presidential election year. And I think the independence of the Fed is very valuable, not only to the United States economy, but also to the Fed itself and for its legacy.
Well, John, in your note, you say that the Fed's data dependency continues, in your view, to be the best course of action to deal effectively with the vexing, sticky inflation that we have seen. But as you know, that data dependency is causing a lot of whipsawing, particularly in the bond market. We're seeing the 2-year move 30 basis points over the course of the last week after some of that data. Is that whipsawing a problem associated with data dependency, or is that a necessary symptom of it?
I think it's an inevitable symptom of it, in the sense that, the bond market, in essence, usually the short end of the curve is very much tied to where the Fed is, which means no cuts for now, higher rates at the near end, while at the far end, the thought is the Fed is going to do the job. But so you do have a somewhat inverted yield curve, not necessarily suggesting a recession in this environment. But the other would be, the thought is here that the market's expectation within the bond market and the pricing of bonds will remain volatile, likely, with the 10-year hovering likely from as low as perhaps around 3.8%, like we've seen, I think, earlier this year, to as high as probably getting close to 5% from time to time, because that's going to be a lot of emotion and excitement and day-to-day trading, an opportunity for traders to make money, and for intermediate to long-term investors to buy babies that get thrown out with the bathwater, whether it's in volatility hitting equities from time to time or hitting the bond market. Attractively price securities will be available through the process of volatility. But it's not the end of this bull market, and we don't think it's the end of the no recession environment with the Fed in hike cycle.
John, let's talk about earnings season so far, because you crunched the numbers. It was, in your most recent note, about 5% earnings growth so far this quarter. It's the highest level that we've seen in nearly 2 years. I'm curious to get your perspective here on earnings so far, if it's enough, whether or not it's enough here to support those future gains, but then also just looking underneath the surface here and talking about what is driving that earnings growth. How much of it is driven by the cost cutting that we've seen?
Well, probably a lot of it is driven by cost cutting, but it's also driven by CapEx in the sense that when we look at, have to look at my screen for this because this moves on a pretty well daily basis, but earnings for communication services, with 12 of 19 companies having reported, earnings growth is up. Are we sitting down 42.25% year over year on the quarter? Then in the case of consumer discretionary, earnings up 40.56%, which gives indication that there is interest in search services, advertising, and in terms of the consumer is still buying stuff, if switching necessarily away from more expensive items and more private label or big box kind of delivery for what they're buying.
So then, John, extrapolating that and also pairing that to going back to your comments earlier when you talked about the economy might be slowing a bit when you take a look at the jobs report that we got out last week, when you take a look at ISM suggesting some slowness there. What does that then tell us just about the short-term trading action that we're likely to see?
Well, it'll certainly bring in more questioning from both sides of the, not political aisle, but here both sides of the investment stories. You know, the traders versus investors aspect, and will likely create, as we mentioned before, the opportunity to pick up things cheaper for investors from time to time. I don't think drastically cheaper at this point. And for traders, you know, the day-to-day action that can be found in uncertainty. But for us, when we look at it, this is, you know, Sean, gosh, I've been in this business for a little over 40 years. It's going to be 41 sometime between May and July, if I'm correct. And I've seen every boom, bust, and recovery cycle. And the extraordinary one about this is that you've got such changes in innovation that really enable both the corporate entities as well as the analytical community, the economists, and the consumer to navigate tougher times with technology more effectively. And it's enabled the Fed to deliver this so far recessionless recovery process.
All right, John, thank you so much. Always great to speak with you. And congrats on that upcoming anniversary. We'll be sure to send you a note then. Thank you so much. That was John Stoltzfus joining us from Oppenheimer there.